Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, April 25, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had another up day today. The SPDR was up a little more than 0.5%. The S&P cash index up over 14 points. Pretty solid day across the board. The Dow was up over 230 points, over 1%. You never love to see the Dow leading the indexes because really it's just a basket of 30 stocks. So it is a little bit top heavy or overweighted, and depending on which companies were up and down today in the Dow will dictate, how much that index is up or down on any given day. So that's why we always look at the S&P 500, and that was up 0.6% on the cash index, and that's a more broader representation of the markets, and that's why we look at the SPDR and the S&P. And so therefore, nice solid update today, and we got above and closed above the critical level of 237.61. We gapped over it and continued higher all day today. It was very nice to see. Basically, this clears the path for new highs coming within the next, let's say, 4 to 6 weeks on the outside. Could happen, obviously, sooner than that. Of course, we've had a couple of nice big up days, gap higher, and eventually we're going to get a pullback, and likely story is we'll probably get a pullback at some point to retest the 237.61 critical level. That will be considered a breakout point. Therefore, it would not be uncommon for the market to come back to check in at that level, 237.61. Whether it happens tomorrow or whether it happens at some point later in the week or next week, eventually it's most likely going to happen. However, as long as the market remains support at that level, then all signals will be clear for new highs coming. Remember, prior resistance will now become support. 237.61 should now be considered support for the market. So by the way, on the upside, some of the near-term targets that we're looking for, first up is going to be $240.50. That's just above the old high. The old high comes in at 240.32. I think what we'll do in the first run is we'll slightly pierce through the old high and get some kind of a reaction at $240.50. My calculation comes this way a couple of different ways. Therefore, I think that price level will be important. And above that, and not necessarily immediate, however, the next major level of resistance, once we break through the old highs and continue higher, of course, there'll be way stations and stops along the way, and I'll refine those as we get there. But the next major level of resistance on the SPDR is going to be $243.50. $243.50. I can't put it on the chart because it's off the chart. I'll write it on for next time. But $243.50 is the next major next major level of resistance after the previous highs. Let's go over and check out the IWM. Now, the IWM was up more so than the SPDR today. It was up about 0.9%. The SPDR was up just more than 0.5%. So we almost got a double out of the IWM. And what you'll notice is on the daily chart, we came into the infamous upsloping trend line drawn over from the monthly chart and backed off that level today. It's just unbelievable how this trend line has respected, or how the market, I should say, has respected this trend line all along the ways at various points in time. When you look at the monthly chart, for those of you that may not remember, we're riding up this trend line. This really started in 2011, October of 2011. We hit it here in 2012, a year later. We hit it here in 2014, in October of 2014. We got below it and stayed below it, and now we're trying to get back above it, but have not been able to get above on a sustainable closing basis. We closed on it a couple of times, but we have not been able to get above this trend line. It just seems to be very, very resistant, or the market is resistant to this trend line. We will break above this trend line, I suspect, in the month of, well, maybe even April or May at the latest. However, it's not whether or not we break above, it's where we close the month. We have to close a month above this trend line for it to be meaningful, and then we would have to confirm a second month above this trend line. That would be a tall order at this stage of the party. But we'll see what happens with the IWM coming up. When you go to the daily chart, you can see we've had a pretty extended move from this most recent pivot low on the 13th down here at 133.66. Now we're up at 140.24. That's a pretty extended move in just over a week's time in the IWM. So the likely scenario is this needs to pull back, and we have a lot of headway, or we have a lot of space in between the important closing level at 138.60. The corresponding level in the IWM is 138.60. We're comfortably above that now. So we can pull back a little bit, eat some time off the clock to work off some of the most recent overbought condition, which is precisely what I think will happen now. Build some energy for another push higher in the IWM. Looking over at the transports today, the transports were the weaker index, down 1/3%, but really it's after another extended move, just like we looked at in the IWM. So it's not uncommon for this to pull back a little bit or stall out here. We're into a pretty good level of resistance up here at the 9,300 level. We cited that level before. It happens to be about a 618 retrace from pivot high to pivot low. So we stalled out here, but we can go sideways here and build some energy for the next move higher in the transport. So I'm not necessarily surprised to see that we lagged today in the transport, stalled out a little bit. I think the market is a little overextended. We'll need to back and fill a little bit. Which one goes first and second? Whether we come down 10 or 15 points in the S&P to back and fill a little bit, whether it's tomorrow or the next day. You got to expect some of that behavior to take place after the move that we had. And by the way, a couple of days ago, at some point last week, I said, I want to bring back the spider. At some point I said, we're going to look back and we're going to have rallied 70 handles or so from the low in the S&P, and that's going to be kind of a, you look back and say, what happened? Well, when you look here, the low was 232, and the high today was almost 239. That's 70 handles in the S&P, and that's what I was talking about. So we rally 70 handles, we have to take a breather. There has to be some backing and filling. We have to eat some time off the clock to work off some of the short-term overbought condition before we can move higher once again. That's the likely scenario. Just for fun, we'll bring up the junk bond index since we talked about it the last couple of times, and we were comfortably, whoa, I don't know what happened to my voice just then. We're comfortably above the 3703 level, closing above that important level once again of 3712. Today's close 3712. So we will make new highs here against the or in the junk bond index, higher highs than February. That's what I'm looking for. That's not that far away. February's high was 3722. We're on our way to break those highs as we speak, and I'll show you where we're likely headed, which is the weekly 200 period moving average up at 3808 as we speak. That'll be somewhat of a moving target, but as that goes sideways to slightly lower, this market will creep up into that level over the next several weeks. That's my expectation, at which point you will find another area of resistance on a pierce of $38 in the junk bond index. Pretty clear cut and dry. Don't have to be a rocket scientist to figure that one out. When you look over at the gold market, sold off again today, only we stayed down rather than bouncing off that level from yesterday. We stayed down near the 200 period moving average. What this tells me is that gold wants to go slightly lower. It may want to come in and test the important level we talked about yesterday, which is 1254.70. Call it 1255, give or take $1 on either side. Something in that neighborhood. There will be a ton of support at that level down there. If you find gold down at that level for a minimum of a scalp trade, an intraday trade, some kind of trade, gold should find support at that level, especially with the 50 period moving average sloping higher leading into that area down at 1248.60. Slightly below that, but in that neighborhood, around that 1250, 1255 level, is a ton of support for the gold market. I would expect a decent rally off that area. A lot of support in this consolidation area where gold spent a few weeks consolidating in and around this area. That will be supportive of the market, and it's not uncommon and completely common for any chart to come back to test a breakout area of which occurred here after this consolidation phase. This is where we broke out, we failed, and this is where we're coming back to retest and check in at that former breakout point. Common garden variety chart behavior. Doesn't matter that it's gold. It could be any chart under the sun. This happens over and over again. Any chart, any time frame. We're just coming back to check in at a former breakout zone. Looking over at silver. Silver also is coming down a little bit farther. You can see the type of candle that we put in yesterday. It was a tail candle, and it looked like we should trade higher, at least even with a retrace. But what happened is we got a retrace today. We still stayed closing so far above this level. The low is 1755, but we'll have to see what happens in the electronic session and the official daily close today. Not sure yet. It's too early to call. If we close below that level, it'll want to come down and probably fill the gap down here at just under 17. That would be a natural thing to happen. That would be a big bite. It wouldn't all happen at once, but it would be very negative for it to close below this level. So we'll see. Need more evidence. Let's look over at the crude oil market. And in crude, we had a little bit of a bounce today, a little bit of a reaction after several days down. But to me, this area is not that important. The $48 level is more important, and more important yet is a break of $46. That would be more important yet. A retest of the old low based on this continuous contract down here at 45.92. That's the important level. I would be a buyer down there. Before that, I would need to see some kind of evidence and a pattern, some kind of bottoming signal, something of the sort to be a buyer before that level in crude oil. Right here where we are today, I'm not seeing the importance of this level. If we put in a bearish pattern, that would mean that crude would want to trade lower. So we need more evidence. Let's just wait for more time to pass and see what the chart tells us tomorrow in crude. Moving along to the bond market, we saw another downtick in bonds today. And remember this, I want to bring this up, which we began looking at Friday. On the weekly close Friday, we looked at it and said, wow, it was very close to our level. We had 155.20. We made a high of 155.16. Didn't quite get there. Put in a doji candle on the 6th week up. And now we're selling off a bit. And we could come down as low as 151.3 and still be in a weekly bullish pattern in bonds, technically speaking. So we're selling off pretty good off of that weekly doji candle. That 151 level 151.3 in that neighborhood puts us right here where all this consolidation occurred. So it does make a lot of sense that the bond market, just like we talked about recently in the gold market, the bond market would want to come back to check in at the former breakout point, even at 151.20, 151.21. This area could provide support to the bond market. This was a breakout point. Don't be surprised to see a bounce at 151.20, 151.22. In that neighborhood could be supportive of the bond market. Also, we've been down a few days in a row now, so it would not be uncommon to find us, if we did trade lower over the next day or two, to find an area for a bounce level because of the amount of days down. This would create a short-term oversold condition. So anything lower than we are in beneath 122 into the 121.5 to the 121.2 area should find support for the bond market. And we'll also cover the dollar, of course, tonight, and the dollar breaking below the 200 period moving average, working its way down to this lower end of the channel. That's what we're looking for. That's where the target is. The target we're looking for is for the dollar to trade to around the 97 area, at which point should create a really, really strong buying opportunity. We'll obviously take a look at what the chart looks like when and if it does get down to that level, but that may just match up in price and time with the perfect recipe for a buy with the dollar with a run for a run up to 105 and potentially higher in the dollar. That's what we're looking for, a target of 97. And with that, I'm going to leave it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.